Buddy, thanks very much for joining us this morning for the first commentary of 2023. I'm going to do the usual format. I'll talk through the first half of the briefing and then hand over to Kieran, and he'll take us through labour market, public finances, and the general assessment. Okay, so we're relative to where we were just pre-Christmas, which was the last commentary that we issued. That commentary struck quite a pessimistic tone for 2023 relative to the previous year. That was really due to the ingrained nature of the inflationary factors that were pervasive throughout many of the large global economies, and also in the Eurozone and the Irish economy, but also due to the possibility of notable downturns in some of the major trading partners, in particular the US and the UK. Relative to that particularly pessimistic context, we're coming to you with a little bit more of an optimistic tone, with the pace of growth both in the domestic economy and the international outlook set to be relatively stronger than we had previously expected at the end of 2022. You know, why is that the case? Well, there are still quite a number of notable headwinds for both the Irish and the domestic and the international economy that we'll talk through, but relative to that previous position, there has been a degree of moderation in the inflation rates and the inflationary outlook, and that really is feeding through into all of the broad aggregates which we'll be presenting today. So if you look at the forecast table there, which is presented on the right hand side, you can see our headline forecast for GDP and for MDD. MDD, just a reminder, is the modified domestic demand. So that is the consumption, household spending, the government spending, and the investment, excluding the aircraft leasing and the intellectual property intangibles from the R&D side. So that's kind of our headline benchmark measure of domestic economic performance. So you can see in 2022, we had an incredibly strong performance for GDP, the 12% growth rate. You know, that was driven by a number of factors, but, you know, very strong international trade figures there are certainly a major component of growth. But as you can see with the MDD figure, there was, you know, quite a strong rebound in the domestic economy as well. You know, driven by a number of factors, particularly strong consumption rebounding from the period in the COVID measures were removed, and then there was a kind of strong increase in spending. Moving forward towards the outlook, you can see the figures presented for 23 and 24 there. The 23 figure is an upgrade on our previous forecasts that we issued in the last commentary, and you can see we're looking at growth of in GDP terms of just over 5% for this year, and 6% for next year, and just under 4% in MDD, tipping up a little bit in 24 relative to 23. So what are the kind of key factors contributing to that particular outlook? Well, as I mentioned earlier, you know, although the price levels remain elevated, we are moderating quite notably our inflation forecast for 2023, and I'll talk through that in some detail. In general, what else is setting the boundaries for the context? Well, in particular, the lower inflation is giving rise to a bigger boost in real household consumption expenditures. So that's one key factor. The second factor is that we have still quite a robust performance in the labour market, you know, with historically low unemployment rates. And again, despite some of the international headwinds that we were mentioning, and some of the further risks I'll talk about in a second, we do still expect to see quite notable growth in the export goods for the particular areas where we have export strengths. So, you know, all of these factors are kind of leading us towards you know, a broad-based growth outlook for the present year and into next year. Over and above that, the public finances are in particularly good shape. Kieran will talk you through these in more detail, but we do expect further surpluses in both 23 and 24 in line with the growth outlook. One kind of cautionary note that comes with the improved economic outlook, and in particular with the very robust labour market performance and the historically low unemployment rates, is that this does give rise to the potential for overheating in the medium term. We're in an economy that, from a labour market perspective, is operating at close to capacity. There's very little surplus labour in the system, and this with any additional stimulant to growth, this can give rise to overheating concerns. So that's certainly a risk that's coming onto the table at present. So to give a kind of lens into the very near-term developments of the business cycle, we're presenting our Nowcast of domestic demand, which is an additional indicator we layered into the system last year. But what you can see here in the chart, the modified domestic demand figures for throughout 2022, which is the dark blue bar here, you can see quite a notable decline in the growth rate. Now, that is to be expected, given the extent to which there was a COVID-based rebound earlier in the year, and we had some of that pent-up demand being satiated as the households were able to re-engage with their expenditure and firms were a little bit more optimistic about their outlook. But you can see there was quite a notable downward trend in that modified domestic demand figure, and that was one of the reasons why we were somewhat more pessimistic at the end of last year, because this trend didn't appear to be moderating. However, if you look at the green bar, which is our in-time forecast for the first quarter of this year, you can see there's been somewhat of a rebound into the first quarter, which gives us a kind of some degree of insight into a turning point in the business cycle, an uptick in economic activity. So you may remember from previous presentations, what's behind this modified domestic demand nowcast is pulling all of those short-term indicators together and to try and give us a kind of real-time lens into how the domestic economy is faring. Okay, so to move to kind of the broad context before I start talking through the specifics of the forecast for each of the components of GDP, let me just kind of set the scene in terms of what are the factors we're thinking about more broadly for the economic context. In terms of the international conditions, Ireland being a small open economy, very globalized, very highly dependent on international trade, one of the reasons why we're a little bit more optimistic than we were towards the end of the previous year is, some of the more severe downside risks have become a little bit less pressing, and particularly when you read some of the international commentaries like the IMF's work, they are actually talking more about some of the upside risks that could be in play for the present year. In particular, where they're talking about some of the bigger boosts from the pent-up demand carried over from the COVID period, this faster than expected moderation in inflation that we're seeing. But we have to be cognizant that they are still outweighed by some of the downside pressures that are there in the system. I don't think we need to labor the point on the ongoing tensions in the war in Ukraine, but certainly any escalation in that situation and any of the broader fragmentation that may fall out from the geopolitical considerations around that context, add to uncertainty and pose challenges to trade. I think one that's really come onto our radar in recent weeks is the banking sector distress, which certainly started with the SVB and the signature bank failures in the US, but kind of propagated as it does through the system and into the European system with the takeover of Credit Suisse by UBS. Certainly what we have seen is the ripples of banking sector distress moving through that system, and the likely implications of that are a further tightening of financial conditions over and above what we were seeing with just the general monetary policy monetary policy rate increases. And really that's kind of adding a cloud over and above the previous risks to the international outlook, you know, to to really understand whether or not this banking system instability is contained, or whether we're going to have further challenges through the degree to which these banking systems are interconnected. But I think it's undoubtedly now a further risk that if there is an escalation in the banking sector instability, that this would lead to a further tightening in credit conditions over and above the course of monetary policy. And this would likely have real economy risks on the downside. The final factor from the international outlook that we highlight really is the fact that, you know, any deterioration in the inflationary outlook, if it becomes more ingrained, or if there's a switch away from some of the energy factors into some of the more core inflationary factors, well, this could lead to a longer period of higher interest rates, and that will obviously weigh on economic activity. Over and above these factors from the domestic side, I think that inflationary switch, or any potential risk that we may have second round inflationary effects, we think is a real risk coming into 2023. So that really is where to date we've seen price rises based on international factors, the energy prices, etc., that have fed through into the prices domestically. So just at this point, once that has happened, the risk is that there's a change in the composition, and that some of the, particularly with the tight labor market, some of the domestic inflationary factors become more ingrained, and they kind of take over as the drivers of inflation, and they're much more difficult to slow down in the medium term. So that's, you know, a potential risk. Leading on from that is the fact, if that becomes more ingrained for a longer period of time, and that is higher than your peer economies, then you're losing competitiveness. And given, you know, our globalized nature, that is quite a risk for us. The other major risk, and we'll highlight this through a number of different pieces of work in the commentary we've done on concentration risk, is really a further correction in the ICT sector. You know, that this sector is going through quite a notable rebalancing, and you know, the SVB challenges in particular may propagate through that ICT sector in more detail. And you know, given the contribution of ICT to employment, to export growth, and in particular to the public finances, any further correction in that sector could have notable downside risks to the Irish economy. So that's certainly a headwind and a risk that we are facing at present. So let me just talk you through the inflationary effects first, because I think this is the biggest change from our previous commentary, and is kind of sets the scene for the rest of the effects. You know, relative to where we were in the early part, or in the late part of last year, there are some signs that there is a moderation in the energy price side of the inflationary equation. And what we have taken into consideration for this particular commentary is quite a notable downward revision in our forecast for inflation for this year. So you can see the forecast table there. You know, our previous forecast for 2023 was just over 7%, and we've moderated that downwards to 4.5%. So in terms of the price growth, we are expecting quite a notable downturn relative to where we were previous in the inflationary effects. Now, you know, I say we're moderating down our growth rate, but the level of prices have increased notably, and naturally that causes pressures, particularly for vulnerable households, you know, who spend a degree of a high share of their income on food and energy. In particular, you know, these households are likely to face considerable challenges, given that the level of price increases has been such in the period just gone. And even though we're pulling down our expectation for the growth in prices, prices are still going to rise in level terms this year and into next year. So that leads me on to household spending, which is one of the core components of the domestic economy. We have notably increased our forecast for this year, for 2023, to just under 5%, so 4.7% in total. And that's really because the lower inflation rate is going to be allowing an increase in real consumption for households. So households are going to see nominal income growth this year. You know, we have the savings story that we've highlighted for a number of commentaries now. You can see the chart here, the green bars, the Irish savings ratio, which remains stubbornly high following the increase over the pandemic period. We are expecting some degree of moderation in this level of savings. So households will be spending an increasing share of their income over time. Coupling that with the nominal income growth, we see a strong outturn for consumption expenditure for this year and into next year. It is a slowdown relative to last year. So we had 6.6% growth last year, but you must remember the early part of last year did have that reopening COVID effect, which pulled the numbers in the early part of the year up. So that's just one piece of context to keep in mind. In terms of the investment levels, we did a very strong outturn for investment last year. Part of that which was explained by the globalization factors from the multinationals, but even the modified investment was very strong. And again, that was caused by two factors. One was just a broad-based increase in general investment activity, which was also related to multinationals, even though the assets were the typical type of assets we'd expect to be included in multinational investment. But also we had a big increase relative to 2021 in terms of the housing completions and the housing output. So there was a big increase for 2022. We are expecting a moderation in the rate of investment in general for 2023. This is really to do with the higher interest rates and the kind of continuing uncertainty from the international challenges. You know, investment is one of those variables that's very affected by both the access and cost of credit, but also in terms of the uncertainty and the degree of security that firms have over the demand profile for their businesses. So we have moderated that down this year. Coupled to that, we expect a lower level of housing output for this year because we saw the housing commencements were down last year. So we have moderated the profile downwards for that. On the traded side, I think we make a number of points. We had very strong trade growth for last year. You know, that's really driven by two particular sectors. The chemicals and pharma sector and the computer services sector really dominate the overall level of trade for Ireland, and these had strong outlooks last year, and we do expect growth to continue in both of these areas. I think one interesting chart to maybe highlight this is this takes the 2022 value of total exports and splits it up between a number of different groups: computer services, pharmaceutical export goods, the rest of the goods trade, and the other non-computer service exports. And you can see half our basket of the goods and services exports are in these two particular items. So we have a very high sectoral concentration of our exports in these two particular areas, and that really does lead to notable concentration risks, in particular around any downturns in these particular sectors. Okay, that notwithstanding, we do see them growing this year. So you can see the forecast table here for exports. We do have strong growth continuing this year and next year in the export channel. So we'd very strong growth last year, double-digit growth last year for exports, and we've had that for a number of years. We do see some slippage in that, down to about 8% growth for this year, and again some slippage next year. But that is still an extremely strong export performance, for the present year and into next year. So let me hand over to Kieran at this point. He's going to talk through labour market, public finances, etc. Thank you.
Thanks, Conor. Thanks, and good morning, everybody. On the labour market, 2023, the preliminary indicators for the labour market in the present year all indicate, continued resilience and relative buoyancy in the sector in terms of employment growth, and particularly in terms of the unemployment rate. In terms of the sectoral performance, obviously, the increase in employment or change in employment, certainly since the pandemic, there's a good degree of diversity across individual sectors. So we see the pharmaceutical sector, for example, performing very strongly since the pandemic. However, other sectors such as accommodation and food, yet to fully recover employment levels from, we'll say, the end of 2019. Obviously, we've seen significant turbulence in the ICT sector. So in terms of the sectoral data that was available last year, we saw, big falls between Q2 and Q3 in terms of the employment numbers, but then the employment levels came back up in Q4. And so obviously that's something we're going to continue to watch very carefully going into the present year when that data becomes available. In terms of wage growth, last year the wage increases was just under 3.5%, which is a little down compared to other years. But obviously in 2021 and 2020, events were obviously distorted by the pandemic. And again, a bit like the employment growth, the degree of wage growth does vary significantly across the individual sectors. As given our unemployment rate forecast, which you can see there, 4.2% for this year, falling to 4% next year, those are historically low rates of unemployment in the Irish labour market. And that would suggest that labour costs and particularly wages are likely to pick up over the coming year in response to that. There have been certain activation measures, I suppose, implemented in the labour market, though, which does mean that possibly the natural rate of unemployment could fall by a little bit lower than it has previously without huge inflationary pressures being generated. But certainly, I think as the unemployment rate continues to fall, you will see wage rates beginning to pick up from where they presently are. If we move on to the public finances, obviously the last year has seen very strong growth in public finances. So tax receipts in total in 2022 amounted to just over 83 billion, which was nearly 22% higher than those in 2021. That's driven across the headings by income tax and VAT up very strongly, but clearly corporation tax registered a substantial increase. As we said before, we welcome the adoption of the National Reserve Fund, which we think is a prudent idea. And obviously there was 2 billion put into that fund last year, with a further 4 going in this year, and presumably 4 going in next year. We do make the point in the commentary that this is a substantial fund and will quite quickly amount to a substantial fund. So therefore, we think there needs to be particular transparency in terms of how the funds are diverted to that, and also what the funds are going to be used for. And just an additional technical point is, as we're seeing reform of the EU fiscal plans, we need to understand how that fund can be used in the context of those reforms of the fiscal plans. Nonetheless, we expect to see the public finances continue to perform strongly this year. We are bidding in as a conservative increase in corporation tax receipts. This is in line with our practice in previous years. So those figures for 2023 and 2024, which are showing, surpluses of nearly 1% and just over 1.5% next year. Those are conditional on relatively conservative growth in corporation taxes. And also inherent in those forecasts is our assumption that further monies will continue to be diverted to the National Reserve Fund. If we move on to the next slide, we can see there's a box in the commentary following earlier work looking at the concentrate, because corporation taxes have become so large, and given the whole issue around sustainability, we look into some of the new data that's available from the revenue commissioners in terms of the contributors to corporation taxes, and as is, it's not a complete shock to find out that ICT and pharma are really very, very significant contributors to corporation tax receipts. And this does again highlight the point that Conor made earlier about the issue of concentration risk and the dangers to the domestic economy of any sustained slowdown in either sector. And that would map through employment, value added, productivity, and also then into corporation tax receipts. Obviously, the other point too, in relation to CT revenues, corporation tax revenues, is the fact that 80% are coming from the top 100 companies. So that is, again, another form of concentration risk in terms of any, significant issues for any of those firms in terms of their performance would have, could have quite a big impact in terms of the corporation receipts. Another box in the commentary which we conducted was to look at the whole issue of inflation and try and see where inflation rate is at presently. This followed some work by a Spanish economist who looked into this issue of what they call instantaneous inflation. Without wishing to get too technical, basically what the gist of the box is showing is that as you attribute less and less weight to observations that are further and further back as far as the calculation of the annual inflation rate is concerned, and you attribute more weight to more recent observations, what you find is that the inflation rate is actually probably a little bit lower, somewhat lower than what the official estimate is. So for instance, while the official estimate of inflation in January 2023 was 7.3%, our indicator of instantaneous inflation would suggest the rate is closer to 4%. And again, the whole idea there is that you're attributing more weighting to the more recent observations of changes in the CPI rather than to the changes which occurred a year ago, because of course those changes a year ago were very substantial in nature because of the issues around the war in the Ukraine, etc. So it's more an additional estimate. It's not suggesting that we should replace the official estimate with this, but it does provide some context as to where the more recent trends in inflation are at, as I said, compared to what the official estimates would suggest. We also have a box in the commentary which looks at the distributional impact of the cost of living measures that were introduced in February. This is by our colleagues Karina Durley, Duggan and Keane. And basically this looked at the extension to the reduced rates of VAT and the lump sum payments to social welfare recipients and their overall distributional impacts. And what they concluded was that lower income households received a proportionately higher increase in their income as a result of these payments, but in cash terms they were pretty equal across the distribution. And the box makes the point that any future cost of living measures again need to be carefully considered in light of the risk and the dangers of overheating in the domestic economy, and that's something that we talk about in the assessment, that as the economy continues to perform strongly, the government has to be particularly careful about any additional measures fueling inflation, in terms of trying to alleviate the impacts of inflationary pressures to start with. So then if we go on to the assessment, overall, as Conor says, we think the economy will perform stronger in 2023, more robust fashion than what we had felt back at the end of last year. This is mainly due to relatively low rates of inflation, the continued strong performance of the labour market, more benign international environment. So obviously towards the end of 2022, there was a somewhat of a feeling that a recession, international recession, could be a distinct possibility this year. That does seem to have receded, although, obviously there are still uncertainties there, and particularly, I suppose, when we think about some of the financial sector tremors that we've seen in recent times, this could potentially have a negative impact as far as credit extension and hence economic activity generally is concerned. Domestically, obviously, the risks that are there surround issues around second round inflationary effects. And obviously we'll continue to monitor what's happening in the ICT sector in terms of whether the kind of correction that has been ongoing in that sector, whether that is a more sustained downturn in activity. That is a crucial question going forward. And again, it touches on the concentration risk issues that we've touched on. Another point that we should note is that in the commentary we have, it's a paper actually, it's not a box, by our colleagues who work in the labour section of the Institute, Aoife Brake and Brendan Walsh, and they're looking in particular on future inpatient bed capacity in the Irish economy. And again, this is, in a more broader sense, this is to do with infrastructural challenges which are out there. But they estimate that at present there is a bed capacity deficit of approximately 1,000 inpatient beds. And whilst they acknowledge that, full adoption of Sláinte care can make an improvement in this regard, they do believe in the medium term, additional government investment in acute hospital system is required to meet both the unscheduled care demand and to alleviate hospital waiting lists. So again, this issue of infrastructural challenges that the economy faces, whether it's in housing, healthcare, or in the climate change, these are all issues which are, obviously warrant significant attention over the short to medium term.